Quarter century ago, insurance executives fought vigorously to keep home care services out of long-term care insurance policies. They knew that the ultimate gatekeeper was the policyholder's fear of entering a nursing home. Providing care in one's own home would create a tsunami of claims that would gobble up reserves faster than any actuary's calculator. Their resistance wouldn't last long, as rapid evolution in the delivery of long-term services and supports demanded the introduction of benefits in the home, community, and a wide range of facilities that offered alternatives to nursing homes. Today, 95% of traditional non-hybrid policies sold are comprehensive policies providing benefits in all of these settings, with nursing home-only policies accounting for only 1% of policies sold and home and community care only plans accounting for only 4% of policies sold. Let's stay home. Medi-Cal, the leading payer for LTSS, encourages elderly Californians to stay home as well. Facing costs of nearly $90,000 per year for a semi-private room in a nursing home, the state desperately needs people to stay home and receive care for $23 per hour, utilize adult daycare services for $77 per day, or move to an assisted living facility or residential care facility for $3,750 per month. Medicare, of course, simply does not pay for LTC. This has been clear for nearly 50 years, but Medicare payments for short-term restorative care and short-term pre-death care in nursing homes continues to confuse customers, agents, and others in the industry. A recent study prepared for the Alzheimer's Association suggested Medicare's cost for Alzheimer's disease would increase from 2% to 24% of Medicare's budget in the next few decades. While the cost for that care may increase to that level, they surely will not be paid by Medicare without massive changes to the program's requirements. The biggest push for staying home comes from our families. A recent study estimated the national cost for informal care, unpaid care provided by family and friends in the home, at $475 billion annually. If the informal care network were a business, it would rank a close second to only the world's largest company in terms of sales, Walmart, at $477 billion. While it appears everyone involved in the LTC industry, the elderly, our families, Medicaid, insurance companies, regulators, and even the White House Council on Aging, want people to receive LTC in their home, the industry remains tethered to its origins, the dreaded nursing home. Based on data produced quarterly by the California Partnership for LTC, the percentage of claims paid for care in nursing homes is only 8% of all claims. Genworth, with more historic claims data than any insurer and the greatest number of nursing home-only policies sold, also reports a dramatic decline in nursing home claims and a rapid rise in home and community care claims. Unfortunately, far too many agents continue to sell the way they have always sold. The dreaded nursing home event is used to instill fear in their prospective clients. Mr. and Mrs. Prospect, you have a 70% chance of needing long-term care at some point in your life, and you could stay in a nursing home for 5 years or more. Both statements have some basis in truth. 7 in 10 of those aged 65 or older will need some form of long-term care at some point in their lives. In addition, some people could stay in nursing homes for 5 years or more. But it is quite the manipulation to suggest, without exactly saying, that 7 in 10 people will stay in a nursing home for 5 years or more. Certainly, you would not allow your prospective clients to make such a connection. However you've positioned the risk, your prospect is now dealing with the fear of going to a nursing home for a long, long time. You have reached them emotionally. Now you need to help them find a path to transfer that risk. How does this sales approach impact the premium you are about to quote? Let's examine 2 key areas: duration in dollars, daily benefit amounts, and how they affect the premium. You've sold your prospects on the high costs of a lengthy stay in a nursing home. In the old days, that translated to unlimited lifetime benefits. In recent years, insurance companies have simply had enough of that risk and typically limit benefit durations to 5 or perhaps 6 years, with an average of 4.8 years as of 2010. You have also sold your prospects on the high costs of care in a nursing home. A quick glance at the cost of care tells you they will need $260 per day for a semi-private room in California. You immediately recognize the meaty nursing home benefits, so you know you'll need to adjust the ALF, RCF, and home community care benefits in accordance with the regulations. 70% of the nursing home benefit for ALF, RCF at $180, and 50% of the home and community care benefit at $130. That should help reduce the premium, but it doesn't, because your policy is still long and fat, and your prospect either can't or won't pay those premiums. If you are really good, you may still be in the conversation with your prospects. You may be backpedaling faster than Tom Brady can let the air out of a football, but at least they haven't shown you to the door yet. It's decision time. Do you adjust duration or do you adjust dollars? Should you go short and stay fat, reducing the duration and holding the line on daily benefits? Or should you stay long and go thin, holding the line on duration and walking down the ladder of daily benefits until they find a premium they can afford? After all, something is better than nothing, right? Wrong. According to LifePlan's 2011 study of who buys LTC insurance, the average duration has dropped from 5.6 years to 4.8 years, but that is hardly short. The average daily benefit is $153 for nursing home and $152 for home care, which compared to costs remains quite thin. Short and fat or long and thin? Which way will you go? Did your prospects buy your new plan design? Based on declining sales of LTC insurance policies over the past decade, far too often the answer is no. Why? Because for most prospects, their agent could not explain how lengthy stay and high costs in a nursing home, coupled with short and fat or long and thin LTC insurance benefits, made sense in transferring their long-term care risks. Let's start with an assumption for every agent selling LTC insurance in California. Start with a California partnership policy. We'll explain an important qualification on that assumption in a moment. With a partnership plan, you can immediately look at shorter durations. 2 to 3 years of coverage will provide adequate non-exempt asset protection for most Californians. Next, you need to take a new look at dollars. Before you do, remember that nursing home claims are now less than 10% of all LTC insurance claims. So we're going to design a plan that provides full protection for 90% of the risk and provides partial protection for the remaining 10% of the risk. Yes, it's time to start looking at the nursing home benefit with a co-payment mentality. Let's calculate 70% of the nursing home cost of $260 per day, approximately $180 per day. Now we're going to use that dollar amount as the daily benefit amount for all care settings: nursing home, RCF ALF, and home community. With this plan design, we can provide benefits for 8 hours of home care per day at $23 per hour and more than cover adult daycare costs of $77 per day. Benefits for RCF ALF care of $5,400 per month, more than covering the average costs of $3,750 per month, plus essential ancillary services that are not included in the basic room and board fees. Benefits for approximately 70% of the nursing home costs of $260 per day. Yes, you are going to discuss with your client that they will have a co-payment of approximately $80 per day if they are among the less than 10% who need nursing home care. This short and fit approach, 2 to 3 years, 180, 180, 180, will clearly lead you to more affordable premiums while providing the right coverage for your new clients. 82% of all policies sold have 90-day or greater elimination periods. Why? We believe it may be because many agents confuse long-term care is provided for 90 days or more with the 90-day elimination period. Well, there is no connection of any kind of these two concepts. The elimination period is simply the deductible the client is willing and able to pay before they receive benefits. Let's look at two examples using a 90-day elimination period. Let's say your client needs home care 3 days per week for 4 hours per day. Their costs in current dollars are less than $100 per day. Their deductible, paid over a 30-week period before they receive benefits, is $9,000 in current dollars. If they think they will need long-term care, they may be motivated by the lower deductible elimination period. On the other extreme, if your client did enter a nursing home at $260 per day, in 3 months they will have paid $23,400. Of course, that cost is in current dollars. In future dollars, 20 years or more from now, your client's out-of-pocket costs could double or more. If they think they will not need long-term care, they may be motivated by the higher deductible or elimination period. Longer elimination periods do result in lower premiums, and shorter elimination periods do result in higher premiums, of course. Make sure you describe the elimination period accurately for your clients and help them understand both the premium and deductible implications. The inflation option is a challenge. California partnership plans mandate 5% compound inflation at most ages. The impact on premium and affordability can be significant. While we're confident the partnership will soon approve less costly inflation options, you may need to recommend a non-partnership plan for the time being. If you do, make sure you write your business with a carrier that offers partnership plans in California. That will make it much easier to convert your clients to a partnership plan when the state adjusts the mandate. In the meantime, a 3% compound inflation benefit will protect your clients into the future. A very important consideration in plan design with partnership policies is determining the amount of non-exempt assets your client needs to protect. As an example, if you design a 3-year plan, 1,095 days, at $180 per day, you have helped your client protect nearly $200,000 in non-exempt assets in today's dollars. If they have more or less non-exempt assets to protect, you can adjust the duration and/or the daily benefit amount accordingly. Is long-term care insurance bought or sold? If you look at sales results since the turn of the century, the answer is clearly not enough of either. The key to selling more LTC insurance is to help more of your clients buy properly designed plans. It's time to untether all of us from the nursing home and start having conversations with our prospective clients that protect them from the real risks of needing long-term care. If you can untether your LTC insurance plan designed from the nursing home, we may all finally be able to experience the real depth of nursing home insurance.